I have watched 11 recessions in my life. I was a boy during the tail end of the Great Depression, barely old enough to understand why my father's grocery store ran on credit slips instead of cash. I was a young man starting out in the investment business when the 1957 recession hit. I built Berkshire through the stagflation nightmare of the 1970 seconds, the savings and loan crisis, the dot-com crash, and the 2008 financial meltdown that nearly broke the global system. 11 recessions. Most were painful but manageable if you kept your head. 3 of them, 1973, 2008, and one other that few remember now, were different. They were wealth destroyers for the unprepared and wealth creators for those who understood what was actually happening. Right now, as I look at the data flowing across my desk in late 2025, I'm seeing the same pattern that preceded those 3 dangerous ones. The same indicators, the same structural fragilities, the same confidence erosion that turns a normal downturn into something far worse. I'm going to share with you the one strategy that protected me in those environments and positioned me to buy world-class businesses at prices you'll never see again. But first, you need to understand exactly what kind of recession is forming, because that changes everything. Right now, as I look at the numbers in late 2025, I'm not guessing about what might happen. I'm watching familiar patterns line up on the page, the same way they have before every major downturn of my lifetime. I've lived through 11 recessions. Some were ordinary colds for the economy. A few were far more serious. The first thing I always ask myself isn't, is a recession coming? The data already answers that. The more important question is, what kind of recession is this going to be? Because that single distinction changes everything about how you should prepare. Most recessions fall into the first category, the normal cyclical kind. The economy overheats, the central bank raises interest rates to cool things down, credit gets tighter, businesses slow hiring, and growth dips for a year or two. It's uncomfortable, but if you own solid businesses and keep your head, you usually come out the other side in decent shape. Prices fall, then recover. Earnings decline, then improve. These are the downturns people have in mind when they say, just ride it out. The second category is rarer and nastier recessions driven by a financial crisis. These don't start with the real economy slowing. They start with too much debt sitting on a fragile foundation. It might be mortgages, it might be corporate loans, it might be speculative bubbles in some new asset class. When confidence in that debt breaks, you don't just get slower growth. You get forced selling, margin calls, bank stress, and a chain reaction through the whole system. Credit, which is the lifeblood of modern economies, stops flowing the way it should. That's what you saw in 2008 when major institutions you thought were permanent suddenly weren't. But there's a third kind of downturn that almost no one talks about, and it's the one that concerns me most as we head toward 2026. It's what I think of as a structural confidence recession. This isn't just about interest rates or a housing bubble or an over-leveraged sector. It's about doubts creeping into the basic assumptions that allow an economy to function smoothly, that rules will be stable, that contracts will mean tomorrow what they mean today, that the people in charge of policy won't wake up and rewrite the game on a whim. When that kind of doubt spreads, it doesn't just change prices, it changes behavior. Right now, I'm seeing signs of all 3 layers at once. On the surface, you can see the cyclical story, growth slowing, consumers feeling squeezed, businesses talking about trimming investment plans. Beneath that, you can spot the financial stress story, corporate debt at stretched levels, certain banks sitting on assets they'd rather not mark to market, pockets of speculation that only make sense in a world where money is free. But under both, there's a quieter shift in tone that bothers me most. Investors, CEOs, and ordinary savers are starting to ask whether they can rely on the same rules they've used for decades. You can see it in how fast capital moves at the first sign of trouble. You can see it in the premium people are suddenly willing to pay for what they perceive as absolute safety, even when the yield is unattractive. You can see it in the gap between what the stock market is implying about the future and what surveys say people actually feel about their own finances. That gap doesn't stay open forever. Either optimism catches up with reality or prices fall to meet sentiment. When those three stories, cyclical, slowdown, financial fragility, and structural doubt, start overlapping, you're not just dealing with another routine dip in the charts. You're dealing with the early stages of something that can shake confidence in ways models don't capture. Most portfolios today are built as if we're only facing the first type of recession. Many risk systems are calibrated to handle the second. Very few investors are positioned for the third. That mismatch between what people own and the kind of storm that may be forming is what creates both danger and opportunity. I don't say any of this to predict dates or exact outcomes. I've never built my fortune on precise forecasts. I built it by recognizing when the character of risk was changing and adjusting before everyone else saw it clearly. That's where we are now. The indicators I watch are telling me we're moving away from a world where you can assume the old playbook will work. Before you can decide how to protect yourself or position for what's coming, you need to be absolutely clear about the nature of the threat. That's the groundwork we have to lay, because the strategy I'm going to share with you only makes sense once you see this environment for what it really is. Let me explain what a confidence collapse actually looks like, because understanding the mechanism is what separates investors who survive from those who get wiped out. Picture yourself holding what you believe is a well-constructed portfolio. You've diversified across sectors. You hold some bonds for ballast. Maybe you've added international exposure or alternative assets. You've done what every advisor and textbook told you to do. You feel protected. Then something breaks. Maybe it's a major regional bank reporting losses that were supposed to be contained. Maybe it's a foreign government struggling to roll over debt. Maybe it's a tech company that everyone assumed was invincible, suddenly announcing layoffs and write-downs. The specific trigger doesn't matter as much as what it reveals. Fragility that everyone knew was there but had agreed not to talk about. What happens next isn't like a normal bear market where stocks drift lower over months as earnings estimates get revised down. A confidence collapse moves faster and cuts deeper because it's driven by a different force. Institutional investors, pension funds, endowments, insurance companies, sovereign wealth funds start running their risk models. These aren't emotional retail traders hitting the panic button. These are systematic processes following rules. Their models notice that correlations are rising. Assets that were supposed to move independently are suddenly falling together. The diversification that was supposed to protect them is evaporating in real time. When correlation across a portfolio approaches one, it means you're not diversified at all. You're just holding different names that are all responding to the same underlying stress. The risk models flag this, and the institutions begin reducing exposure across the board. That selling creates price declines. Those price declines trigger risk warnings at other institutions. More selling follows. It's a reflexive loop that feeds on itself. Each wave of selling makes the next wave more likely, because each decline increases measured volatility and correlation, which triggers more systematic selling. You don't need panic to create a crash. You just need enough rules-based selling happening at once. Here is the part that surprises people who haven't lived through one of these. The assets you thought were safe stop acting safe. I watched this in 2008. Treasury bonds held up, yes, but plenty of other supposedly stable assets didn't. Investment-grade corporate bonds from companies everyone thought were rock solid traded like junk. Municipal bonds, which were considered nearly as safe as treasuries, sold off hard as liquidity dried up. Money market funds, instruments that were supposed to be equivalent to cash, faced the prospect of breaking the buck, falling below their $1 per share net asset value. The government had to step in with emergency guarantees to prevent a full-scale run. Why does traditional diversification fail in this environment? Because it's built on an assumption that only holds in normal times, that different asset classes respond to different drivers and therefore move somewhat independently. But when the stress is about confidence in the system itself, when the question isn't which sector will do well, but rather, can I trust any of this? Everything moves together. The foundation underneath all those different assets is the same. A functioning credit system, reliable counterparties, enforceable contracts, stable rules. When that shared foundation cracks, nothing is truly separate. I saw portfolios in 2008 and 2009 that looked prudent on paper lose 40% or more. These weren't reckless speculators. These were people who had listened to good advice about diversification and risk management. The problem wasn't the concept of diversification. The problem was that their different holdings were all standing on the same ground, And when that ground shifted, it didn't matter how spread out they were. This is why the conventional wisdom, hold a mix of stocks and bonds, diversify across sectors, ride it out, could devastate portfolios in what's coming. We're not looking at a garden variety slowdown where some areas of the market struggle while others hold steady or even gain. We're potentially facing an environment where the correlations that normally protect you disappear precisely when you need them most. The math that said you were taking moderate risk will turn out to have been based on assumptions that only worked in calm conditions. Now, I'm not telling you this to scare you into paralysis. I'm telling you because you need to understand what kind of fight you're in before you can choose the right strategy. There is an approach that not only survives this environment, but actually thrives in it. It's an approach I've used before in 1974 when stocks were down nearly 50% and stayed down for years. And again in 2008 and early 2009, when the financial system itself seemed at risk of collapse. The strategy works precisely because it doesn't depend on correlations staying low or markets staying rational. It doesn't require you to guess which sector will hold up or which geographic region will be spared. It's simpler and more robust than that. But to understand why it works, you first have to let go of the idea that staying fully invested at all times is the only way to build wealth. Sometimes the most aggressive thing you can do is wait. My number one strategy for this environment is straightforward. Hold substantial cash or highly liquid short-term instruments before the crisis intensifies. Then deploy that capital systematically to buy exceptional businesses at discounts that only appear when fear peaks. I know exactly what you're thinking right now. That sounds too simple, or maybe too cautious. Cash has been a drag on returns for years. Holding it while your neighbors got rich in the bull market felt painful. Or maybe it sounds too risky. Deploying capital into a falling market feels like catching a falling knife, and everyone knows that's dangerous. I understand all those objections because I've heard every version of them over 80 years, and I've felt the pull of them myself. But in doing this right now with my own capital, Berkshire Hathaway is currently sitting on over $300 billion in cash and short-term treasury bills. That's not an accident, and it's not because I can't find anything to buy. It's because I'm waiting for the right prices, and I have strong reason to believe those prices are coming in 2026. Let me show you why this works. The strategy is built on a simple asymmetry that most investors overlook because they're trained to think that being out of the market is always a mistake. In a confidence collapse, the downside protection from holding cash is enormous, and the upside optionality when everyone else is forced to sell is even larger. When the market falls 40% or 50%, not losing money is effectively the same as making a massive relative return. If I'm holding $100 in cash and the broad market drops 40%, I haven't made $1 in absolute terms, but I've gained 40% in purchasing power relative to every asset I actually want to own. That purchasing power can then be deployed at prices that offer expected returns you will never, ever see in a normal market environment. Here's what most people miss. They confuse the opportunity cost of cash during a bull market with the strategic value of cash in a crisis. Yes, if you held 30% of your portfolio in cash through 2023 and 2024, while the market climbed 20% or more each year, you underperformed. That hurts. It's psychologically difficult to watch. But if you hold that same 30% cash position through 2025 and deploy it intelligently in 2026, when quality businesses are trading at 50 cents on the dollar, you've just set yourself up for compounding returns that will dwarf anything you gave up by being cautious. The math is overwhelming once you see it clearly. Let's say I buy a business in normal times that's genuinely worth $100 per share, and because I'm disciplined, I wait for a decent price and pay $90. That's a solid purchase. I've got a 10% margin of safety built in. But now imagine I wait through a panic and buy that exact same business with the same earnings power and the same competitive position for $50 per share. I've just doubled my margin of safety to 50%. More important, my expected return from that lower entry price is dramatically higher. If that business returns to its intrinsic value of $100 over the next 5 years, I've made a 100% return from my $50 entry point. I've doubled my money. That kind of return opportunity simply doesn't exist when you're buying at $90 or $95. The lower price doesn't just give you more upside, it gives you room for error, time for the business to compound, and protection if your estimate of value turns out to be a bit optimistic. The counterintuitive piece that people struggle with is this: the worse things get in the market, the better the opportunities become, but only if you have dry powder to deploy when others are out of ammunition or too frightened to act. In 1973 and 1974, I was buying shares in wonderful businesses at prices that made absolutely no sense if you took even a few minutes to think about what you were actually getting. I bought the Washington Post company at a total market valuation of around $80 million, when any informed buyer would have happily paid $400 million or more for the whole enterprise. The market was valuing it at 1/5 of its clear worth because fear had completely overwhelmed reason. I had the cash to deploy because I'd been patient in the overvalued market of the early 1,970 seconds. I hadn't chased marginal ideas just to stay fully invested. When the opportunity appeared, I was ready. That position in the Washington Post became worth billions of dollars over the following decades. The return didn't come from predicting what the market would do next week or next month. It came from having capital available when a great business was on sale. That's half the battle, having the cash. The other half, the part that separates those who actually execute from those who freeze or fumble, is knowing exactly when and how to deploy it. There are 3 specific signals I watch to guide that timing. And as we sit here in late 2025, 2 of them are already flashing. Let me walk you through the 3 signals that tell me when to stop waiting and start moving, because having cash is only useful if you know when to turn it into ownership of real businesses. The first signal I watch is credit stress. Not headlines, not talking heads, spreads. When investors start demanding a much higher yield to own corporate bonds instead of short-term government paper, that's the market quietly admitting it mispriced risk. When those spreads move sharply higher over a short period and stay there, it tells me fear has moved from opinion into pricing. I don't need them to reach some magic number, but I do need to see a clear break from the complacent levels that prevailed during the good times. That's usually the first indication that the tide is going out and we're about to see who's been swimming naked. The second signal is volatility, not on one wild day, but in a sustained way. I pay attention when the market's fear gauge rises sharply and refuses to settle back down. When you see days where indexes move 2 or 3% in both directions, and that becomes normal instead of exceptional, that's not just noise. That's the sign of a market struggling to find a clearing price in the middle of forced selling, margin calls, and shifting expectations. When those big swings cluster together over weeks, that tells me we're moving from the denial phase into the real liquidation phase. It's during that period that some of the best businesses in the world quietly get marked down to absurd prices simply because they're sitting in the wrong portfolios at the wrong moment. The third signal is behavior from people who know more about a specific business than you or I ever will, insiders. I don't mean a single director buying a token amount of stock. I mean concentrated, repeated buying by CEOs, founders, and long-tenured managers who already have plenty of exposure to their own company and still reach into their own pockets to buy more at lower prices. When I see across the board fear in the headlines, but calm, deliberate buying in the filings from people closest to the cash flows, I pay attention. That combination, widened credit spreads, elevated volatility, and real insider accumulation is rare. When all 3 line up, history shows you're standing very close to a generational opportunity. Now, how do you actually put money to work when those signals are flashing? You don't jump all in at once. I never pretend to know the bottom, and neither should you. What I like to do is divide my available cash into stages. Maybe it's 4 or 5 tranches. When credit spreads hit a certain stress level, I'll deploy the first slice into my highest conviction names. When volatility spikes and stays elevated, I'll put the next slice to work. Again, focusing only on businesses I understand deeply. When insider buying becomes broad and aggressive while prices are still depressed, that's when I get more aggressive with the remaining capital. There's one more layer: what I buy. In these periods, I'm not hunting for lottery tickets. I want companies with fortress balance sheets, durable competitive advantages, and management teams that allocate capital intelligently. I care far less about whether they beat the next quarter's earnings estimate and far more about whether they can survive a severe storm without issuing stock at low prices or begging their lenders for mercy. If a business can keep generating cash, keep investing in itself, and even repurchase shares while everyone else is repairing damage, the math over the next decade becomes very favorable from a low starting price. The key is that this framework doesn't require you to predict the exact day the market will turn. It simply requires you to recognize when fear has become indiscriminate and when the people closest to the fundamentals are quietly acting in the opposite direction of the crowd. When two of these signals are active, I lean in. When all three are present, I consider it a once-in-a-decade invitation. And remember, the strategy only works if you've done the patient, boring work beforehand, building that cash position while everyone else was convinced the good times would last forever. You're now starting to see why the next part of the story isn't just about numbers. It's about temperament and philosophy, because having the right playbook is one thing. Having the mindset to run the play when the field is covered in mud is something else entirely. When people quote me saying, "Be fearful when others are greedy and greedy when others are fearful," they treat it like a slogan. For me, it's not a slogan. It's a survival rule that grew out of one simple truth about markets. In the short run, they are voting machines. In the long run, they are weighing machines. Prices swing wildly around value because human beings swing wildly around rationality. My strategy for this coming recession rests entirely on that gap between price and value and on the fact that fear widens it more than anything else. I learned this very early. As a young man reading Ben Graham, I was introduced to a character he called Mr. Market. Every day, Mr. Market shows up at your door offering to buy your interest in the business or sell you his at a price of his choosing. Some days he's euphoric and quotes silly high numbers. Other days he's depressed and practically gives businesses away. The key insight is that you are never obligated to trade with him. You get to choose when his mood works in your favor. In a brutal downturn, Mr. Market is at his most miserable. That's exactly when my strategy demands that I become most active. If I've prepared properly, take what happened in the mid-1970 seconds. Inflation was high, confidence in political leadership was low, the oil shock had rattled everyone, and stocks had been falling for years. The Dow Jones Industrial Average dropped from over 1,000 inches, 1,973, to around 570 inches, 1,974. Many investors simply gave up. They weren't thinking about intrinsic value anymore. They were thinking about how to stop the pain. During that period, I bought a large stake in the Washington Post Company. The entire business was valued by the market at roughly $80 million, based on any reasonable analysis of its assets, earnings power, and competitive position. It was worth at least $400 million. That meant I was buying $1 for 20 cents. Nothing magical, nothing complicated, no exotic derivatives, no forecasts of interest rates, just a simple comparison between what the business was actually worth and what a frightened market was willing to let it go for. That investment multiplied in value many times over the following decades. Not because I was clever about timing the bottom, but because I was willing to act when most people were frozen, and I had structured my own finances so I could afford to act. The same basic pattern repeated in 2008 and 2009. When major financial institutions were tottering, when headlines were screaming about the end of capitalism, there were businesses with durable franchises that the market was pricing as if they might not survive the year. I made investments in companies like Goldman Sachs and General Electric on terms that reflected the panic of the moment, not the long-term earning power of the underlying businesses. Those deals were structured to protect our downside and give us substantial upside if sanity returned, which it eventually did. The strategy I'm describing to you now for the 2026 recession is not new. It's the same one I've used my entire life. Hold your fire while assets are priced for perfection. Build liquidity while others are stretching for every last bit of return. Then buy simple, understandable, cash-generating businesses when they're temporarily priced as if they're permanently damaged. Cash is the bridge that lets you cross from fear to opportunity. Intrinsic value is the map that tells you where to go once you're on the other side. But this only works if you're willing to look past the next quarter, the next year, sometimes even the next 3 years. When I bought the Washington Post, I wasn't thinking about what the stock might do in 6 months. When I invested during 2008, I wasn't counting on a quick rebound. I was asking a different set of questions. Will people still need these products and services in 10 or 20 years? Does this company have a durable competitive advantage? Is management honest and capable? And am I paying a price that already assumes a lot has gone wrong? That last question is critical. In a panic, the market bakes a tremendous amount of bad news into prices. It assumes lower earnings, slower growth, higher funding costs, and sometimes outright catastrophe. If you can identify situations where even those grim assumptions still leave you with a margin of safety, you don't need optimism. You just need reality to be slightly less awful than the market expects. That's often what happens. Things get bad, sometimes very bad, but not quite as bad as the most frightened people imagined at the darkest moment. So when I tell you that my number one strategy is to sit in cash and then buy aggressively in the teeth of fear, understand that it's not about bravado. It's about arithmetic and psychology. The arithmetic says a great business bought at half of intrinsic value will, over time, give you an excellent return, even if the world doesn't become wonderful. The psychology says almost no one will be willing to buy at that moment unless they have prepared themselves long in advance. The next part of this conversation has to be about that psychology, about the inner obstacles that will try to stop you from doing the right thing exactly when it matters most. The three biggest obstacles you're going to face in this strategy aren't out there in the market. They're in here inside your own head. I've been investing for more than 8 decades, and I still feel them every single time the world looks like it's coming apart. The first demon is paralyzing uncertainty. In the middle of a real downturn, every decision feels like a guess, and if your strategy depends on picking the exact turning point, you're not investing, you're gambling. The way I deal with that uncertainty is simple. I assume I will be early and build that assumption into the plan with tranches, accepting that it'll feel foolish for a while as long as there's a wide gap between price and value and enough time for that gap to close. The second demon is social proof turned upside down. We're wired to look to the crowd for clues about what's safe. So when prices are collapsing, it feels almost arrogant to say, I'm going to buy, but you don't need to know more than everyone about everything. You just need to know one business very well and be willing to act on your own homework while others run. The third demon is loss aversion. Losing $1 hurts roughly twice as much as gaining $1 feels good. So when your portfolio is down 30%, deploying new cash feels like pouring water into a leaking bucket. The mental shift I make is that I'm not adding to losses. I'm reducing future regret. If I believe a business is worth $100 and I can buy it in stages at $60, $50, and $40, each purchase lowers my average cost and raises my future return, assuming the business survives and thrives. I also change the time frame in my head from how will this feel in 6 months to how will I feel in 5 years? Because by then you won't remember the exact day you bought, only whether you owned great businesses at great prices or froze because it was uncomfortable. So as we move toward this 2026 recession, understand that the real battle isn't just with interest rates or GDP. It's with your own wiring, and you need a plan that expects those instincts and keeps you acting on principles instead of impulses. No one, not me, not the Federal Reserve, not the commentators on television, knows exactly how deep this recession will go. What we can do, based on history, is prepare for a range of outcomes and build a strategy that works across all of them. When I look out at 2026, I think in terms of 3 broad paths: a mild slowdown, a moderate recession, and a severe crisis. In a mild downturn, the economy might contract modestly, unemployment ticks up, the stock market falls 20 or 25% and then recovers within a year or two. People feel uncomfortable, but the system holds. And the cash you build up isn't wasted. You simply deploy maybe half of your reserves as quality companies go on sale at 30 or 40% below their highs and accept a little short-term underperformance in exchange for safety. In a moderate recession, which I'd consider the base case given today's leverage and imbalances, you might see a 30 to 40% market decline and a couple of years of weak growth. That's where the staged deployment strategy becomes especially powerful. As spreads widen, volatility stays high, insiders buy, and you put 70 or 80% of your reserves to work slowly into wounded but viable businesses, letting the market come to you rather than chasing every drop. The third scenario is the one people prefer not to think about. A severe crisis with 50+% declines, failures, or forced mergers of major institutions, and real doubts about whether the financial plumbing will hold. In that environment, the emotional pressure to abandon your plan is immense, but owning cash when everything else is cut in half is like standing in a deserted luxury store with a suitcase of money and a 90% off sign in the window. The job then is not to be a hero from day one. It's to survive the storm with capital and judgment intact, maybe deploying tranches at 30, 40, and 50% down while keeping some in reserve, and focusing almost entirely on the highest quality businesses with strong balance sheets, essential products, and proven management. So you're picking up diamonds, not catching falling knives. The key point is that the same basic strategy, build cash in good times, buy great businesses at discounts in bad times, follow clear signals instead of feelings, doesn't require you to know which path well follow, only to accept that you don't know and prepare for all three. The real risk isn't choosing the wrong scenario. It's drifting in with no plan, fully invested in whatever worked in the boom, and hoping gravity won't apply. Hope is not a strategy. Preparation is. And in the final part of this conversation, I'm going to leave you with the handful of principles I never violate in environments like this, because they're the guardrails that keep this entire approach from becoming just another set of good intentions. In environments like the one we're heading into, I keep coming back to a small set of principles. They aren't complicated, but they're non-negotiable, and I've tested them through wars, inflation, bubbles, crashes, and political chaos. The first is that I do not use leverage. Debt can make you feel richer in good times, but makes you fragile in bad times, because margin calls don't care about your analysis or intrinsic value. They just force you to sell when you most want to hold or buy. Second, I never stray far outside my circle of competence. In a crisis, any illusion that you understand a business you've only glanced at vanishes. So my blunt rule is that if I wouldn't be comfortable owning the whole company at today's price with my own money, I don't buy a single share. Third, I remind myself constantly that price is what you pay and value is what you get, anchoring on cash flows, assets, and competitive position while letting price come to me, and if it never gets attractive enough, I'm content to sit on cash rather than lower my standards out of impatience. Fourth, I stretch my time horizon so volatility becomes opportunity, not verdict, and focus on what a business will be earning 5 or 10 years from now instead of what a screen shows this week. Fifth, I treat emotional discipline as more important than intelligence, using rules and pre-commitments, how much cash to hold, what qualifies for deployment, how to stage buying so that when fear spikes, I follow a plan made with a clear head instead of improvising with a clouded one. For you, sitting in late 2025, looking toward a possible 2026 recession, this means you have homework. Examine your own balance sheet for leverage, define the few industries and companies you truly understand, build a watch list with rough intrinsic values, decide how much liquidity you're willing to hold, even if it makes you feel foolish, and write down the rules you'll follow when the warning signals appear. This downturn, whenever and however it arrives, will hurt people. Some of that is unavoidable, but much of the damage comes from walking into storms with no raincoat, no map, and no plan. And you don't have to do that if you're willing to trade a bit of comfort today for more resilience tomorrow. I've built my fortune by being willing to look foolish in the short term to be right in the long term, by being greedy when others were fearful and fearful when others were greedy. And the recession of 2026 will also pass 5, 10, 20 years from now. Markets will be higher. And the real question is whether you'll say, I panicked with everyone else, or I prepared, I kept my head, and I used that fear to buy a better future.